Let's be honest, there's a lot of people spouting shite out there about what they are making. So I'm going to show you exactly what I am making from my serviced accommodation properties. Since 2019, I've been buying properties and refurbishing them. I want to go through all the numbers and show you how much money they've actually made, how much tax you have to pay, and what the cash flow is, even if the interest rates push past the recent peak of 6.1%.
A reminder of that all too familiar stepladder upwards of the bank's interest rates, the driver behind more expensive mortgages. We've gone from 0.1% in November 2021 to 5%.
People all over the world use property to achieve financial freedom, so pay attention. If I told you I can show you a way to make more than £3,000 net profit per month per property, would that keep you interested? If so, keep watching until the end. Now, I have bought a fair few properties since 2019, so I've decided to pick the last 5 projects, as you'd assume that you get better at your strategy as you get more experience, and I want to provide you with the most valuable information out there, so hopefully that works for you. I will, however, reference back to some of my earlier deals and the horrendous mistakes that I've made so that you can avoid them. The last property I bought was actually one of my first properties I ever hosted on Airbnb. Now you're probably thinking, how does that work? Well, somehow as a fresher into the industry, I managed to pull a lease option deal off. How? Some might say pure beginner's luck. Some might say I have a knack for solving problems. I'll go somewhere in the middle. And that's the first top tip for you right there. Property investing is about solving problems. Someone wants to sell their property to either release the capital or avoid the debt. It's your job to find out which and then put a deal together that works for both parties. In this case, the owner was trying to solve a debt issue. They had inherited the property, had a bad tenant trash the place, the property wasn't in a rentable condition, and they didn't have a job, so they couldn't fix it back up to get it re-rented. They were building up mortgage arrears and were in a very sticky situation. They had the property hugely overvalued and it was advertised on Gumtree for sale and for rent. So after understanding their situation, I told them I could pay them 95 grand, but not yet. They would have to wait until the market went up in value. Now, I don't want to focus too much on lease options, as this is actually the only one I've ever done, and I think BRR or rent to rent is a much better strategy, but in a quick 30-second crash course, this is how they work. You agree a price to purchase the property at a time in the future, ideally when you know it will have appreciated to that value. You take over all the running costs, the maintenance, and effectively it becomes your property. You would cover any refurbishments and you would pay the owner a consideration fee to initiate the contract. The minimum amount can be £1 single pound. All the profit is yours from the day you take the keys, or losses if you get into a bad deal. The biggest mistake I've made so far, which cost me around £500,000, was chasing quantity of properties rather than quality. I learned the hard way, so please don't do the same. Thankfully, I stayed in business and I can share the lessons with you as my business is more profitable than ever now after learning from that mistake. More on that later. Fast forward 4 years into the 5-year agreement and I bought this property for 73 grand. I mentioned 95 grand before, but it ended up going through court as the seller didn't uphold the lease agreement. A valuable lesson learned there. Number 1, ensure a good legal contract is in play. Thankfully, I did this right even as a novice back in 2019. And number 2, when you're solving a problem for someone financially, they will be your best friend. When they feel like they are losing out, as this vendor did when the market started to fly up post-COVID, they became a nightmare to deal with. For me, this is why I now like to just buy the property and own it as soon as possible. So let's dive into the figures and have a look at this. So you can see here, Newcastle, 1-bed flat. It was advertised at 125,000 initially. I made them an offer of 95 grand and obviously it was accepted. I left it as a 1-bed flat and these are how the numbers played out. So 73 grand purchase price, stamp duty 2190, 1,050 legal fees, refurb cost 12,392. This is kind of what I did, new bathroom and decoration, furniture, and then in 2023 I upgraded the kitchen, more decoration, new carpets, new furniture. So there was a total of 12,392 across the 2 refurbishments that I did. No sourcing fees, mortgage broker fee of 299. I used investors' money to buy this property in full, so I haven't put any deposit into the deal. I borrowed the full 73,000 and I then take in on average 1678, so 19483, 3466. So you'll see here we have the averages. Belgrove 1733, which is what we're taking in on a monthly basis on average from this property. 550 in terms of operational costs, £19 insurance, which leaves me with a net profit of 495, which is a bit on the low side, but I'm going to come on to that later and tell you exactly what you should be doing. The new market value of the property is 135 grand. So after we've done the refurb, obviously we go for the refinance. We get 135. We take a 75% loan to value mortgage out on this property, which gives us 101,250 back. Mortgage arrangement fee was 2 grand. Broker fee 300 quid. Our new monthly payment is 447. And you might notice here my mortgage payment, or what it was to the investor payment here, was 614. So my borrowing payment, even though I'm borrowing more, is actually going down, but that's because my private investor funding is obviously at a much higher rate than my mortgage. Flip viability calculator, obviously I'm not flipping it, so I don't need to go through this, but if you wanted to flip, that would give you the details. The profit from the deal would be circa 40k. Total investment cost 17.5, monthly cash flow 495. This is if I was going to buy to let it with no refinance. I'd have 35 months before the money was left in the deal, and this is where the magic happens for me because I do refinance all the properties. So total investment cost 19,824, so that's your refurb, your stamp duty, all that sort of stuff. Refinance monthly cash flow, so that's gone up because obviously my debt payment is gone down from the 600 odd down to the 447. Cash out refinancing is 27,941. So as you can see here, the money left in the deal is actually minus 10,451. So that means I actually got 10.5 grand cash back on this deal. And yes, that does happen. Not very often, I might add, but it does happen. So obviously I've got no money left in the deal. I've created 42 grand's worth of equity. Return on capital employed 40%, return on investment gross 28%, return on investment net 8%. So all in all, a pretty decent first deal. And, you know, although I bought it at a later date, obviously at the beginning I had on a lease option, so I didn't have to invest as much into it in terms of the setup and the bridging fees and all that sort of stuff. Sorry, the investors' fees. But it yielded, you know, a nice rate. I was actually only paying her mortgage at the beginning, and because she was on a low mortgage, it was only costing me about 180 quid a month. So the return on the investment throughout the project has been very, very healthy, and now I actually own that property and it continues to cash flow, and I've got no money tied up in that deal. In fact, I've had money back, which I then use to reinvest into other properties. Now the magic here is not only I have managed to get 10,451 cash back into the bank account to use to buy more properties, I only have a mortgage balance of 101,250 against a property valued at 135 grand. So I've created 35 grand's worth of net wealth, which will grow over time. I have no money tied up in the property, and it gives me an income of 7.5 grand per year. A bit on the low side for what I want, but I'm going to come on to that shortly. But in the main, it's not a bad deal, if I may say so myself. And this is how the end product looks. Now, I will need to pay tax on the income, and I will also pay VAT on the bookings. However, not all of them, due to the relief available for bookings over 28 days. You can also use the Tom's VAT scheme for some of your properties, which can possibly reduce your VAT liability. If you'd find a video helpful on the Tom's VAT scheme, comment Tom's below and I'll put one together if enough people ask. The tax you will pay depends on the way you set yourself up. There are many arguments for purchasing in a personal name and also wrapping up your properties in a limited company. If you're a high rate taxpayer, then the personal route probably won't be as advantageous, especially since the introduction of Section 24. I personally run all of mine through limited companies, and I use specialist tax consultants to help me navigate my way around all the tax situations to protect my assets and my profitability. All above board, of course. However, the majority of investors never delve into these strategies, so end up paying far too much tax, which means less money in your back pocket to reinvest and continue to scale. You see, how this all works, investing in your knowledge and employing specialists will actually make you more profitable so that you can scale at a faster pace. One thing I wanted to stress here is that, in my personal opinion, smaller properties and flats are a lot higher risk in this game, and as such, I would not advise investing in these type of properties. The only reason I bought this was because I committed to it in 2019 as a lease option. So what would I recommend? Again, Just my personal opinion. However, it is a data-driven one, having hosted over 200,000 guests, bought millions of pounds of stock, and experienced this business on the front end for the last 4 years. For me, the best business model is high profit and low hassle. If you're not careful, running a lot of small, low profit units will drive you into the ground with the stress and the hassle of it. These businesses are far from passive, and you have to box clever. Hopefully by the end of this video, you will agree with me and start investing this way after I've shown you all of the data of these 5 properties. So next up, I bought a 3-bedroom terraced house that had a reception room. These are the perfect type of properties to buy, as you can easily add value, and the extra room can bring in anywhere from 5 grand to 10 grand per year in extra income. This is how it turned out, and these are the numbers in detail. So we've got a 3-bed terrace. It was advertised at 165 and I made an offer of 135. It was accepted at 141876. I turned it into a 4-bed using the downstairs reception room, and this is how the numbers played out. I used a bridge and loan for this, so I would put in 30% deposit of my own. So that's where the 44,562 comes from. As you can see here, a just over £21,000 refurb, bathroom, kitchen, ensuite, carpets, decoration, wiring, plaster, and a few other additional bits and bobs. My bridging fee is obviously $844 a month, because bridge and loans you will pay a higher interest because it's short-term hard money lending finance. The rent on this is $3,263. A very, very good project for me. As I said, I believe these bigger projects do bring in a lot more revenue. So on average, that's what it's kind of bringing in. $950 operational cost, 24 insurance, so we're netting just over or just under $1,500 a month, which is very lucrative. 18 grand a year from one single property. 180 grand refinance, so we got £135,000 back. We then used that to pay off the bridge and loan of 99,314, and then whatever's left over, so we're talking 35 grand there or thereabouts, that helps to cover the costs of the stamp duty, the refurb, and all the other extras, the broker fees, etc. So as we refinance it back out, you can see here we get 35,387 back out. Total investment was 74,148 initially, because obviously I had to put the deposit in there. We have 37,112 left in the deal, which is a bit more than I would normally like to see in there. But because obviously the property is going to be making 1,500 net a month, then we're actually only 19 months into this project before we're fully break even. Then I own an asset that has quite a decent amount of equity in the property from day one. It's cash flowing me 18 grand a year, and it's giving me a 12% net return on my investment. Now, one thing I want to come on to here is the stress test, as it is important for serviced accommodation mortgages, as in the majority of cases, even on the SA products, they will still revert to the traditional buy-to-let stress test and the bricks and mortar valuation for these types of properties. If we just type into Google what is stress test for UK mortgages, it's going to give us the exact explanation. So a stress test will look at whether or not a borrower will still be able to meet their monthly mortgage repayments plus all other necessary budgeted expenditure if mortgage rates were to increase to a specified amount, usually around 8%. This is particularly important when mortgage interest rates are low. So recently we've seen a time of very low mortgage interest rates, but when a mortgage company lends, typically they're lending for 25, 35 years. So they're not always going to be low. So what they need to do is protect themselves. So they need to say, if that rent was received, but the mortgage rates went up to 5, 6, 7, 8%, does the rent still cover what the mortgage payment would be? So typically the stress test is worked out at how much rent you're receiving, and if there was an interest rate of around, say, 7 or 8%, sometimes worked out on 5.5, although we're now at that region now in terms of interest rates from where we were sort of 2 years ago or even just a year ago. And then it will normally be either 125% or 145% of that rent amount. And if it then still covers the mortgage, then it falls in line with the stress test and then they will lend. If it doesn't, then they'll say that the rent is not going to cover the mortgage at that stressed level, and therefore they more than likely will not lend. So you also have to, whilst they're going to take in the AST revenue rather than the actual short-term rental income to do the stress test, because they're always going to cover their backs that not everybody does serviced accommodation. So if they get that property back into their portfolio, are they going to be able to rent it out, or are they able to sell it based on the bricks and mortar valuation as a tenanted property or as a residential property, not as a short-term rental or serviced accommodation business. So that's just, something that you need to consider when you are getting your mortgages. And it's really important that you do all this research at the beginning before you buy a property, because the last thing you want to do is buy a property, especially with a bridging loan or in an auction or using investor money, and then you can't refinance out of it at the end. Stick with me here for the rest of the video, as you're going to start seeing some common patterns emerging to back up my claim that these are the perfect properties to be investing in. And if you haven't already done so, hit the share button below and send it to at least one person you know that will benefit from this video. Now, this was one of my better purchases over the last few years. It was originally two-bed flats, and the previous owner had knocked them together, although the use of space wasn't great. After a bit of playing around with the floor plan, I managed to figure a way out to squeeze a fifth room in and add an extra shower. It's really important when running large serviced accommodation properties that you ensure there are enough showers, as quite often you will have anywhere from 5 to 8 people in the property. And on that note, you need to make sure your heating system is up to the task as well, something I added on this refurb. So let's take a look at the numbers. So here we go again. So we advertised price 145. I turned it into a 5-bed using the downstairs room. I ended up dealing at 124,856. My initial offer was 115. So as you can see here, there's always a bit of negotiation. These are the costs. Refurb, quite a lot more than the last 2 refurbs. So, coming in at just under 40K. I actually used bridging and investor money on this one. So you might be thinking, well, how does that work? Well, I bridged 70% of the 124, and then I used the investor money to actually fund the deposit refurb as well. So we then have, multiple payments going out for both elements of the finance. 4121 was the on average costs coming in, and still to this day is revenue. So 4121, you can see they're coming in. As you can see here, this property year to date, as of the end of October, has brought in over 40,000, and my estimated running costs of the property are only 18 or just shy of 19k a year. So a very, very lucrative property. New market value on it was 200 grand, so I get 150 grand loan. I pay back the bridging loan, I pay back the investor, and then as we go back to the refinance, you'll see here there's 21 grand. So you're now thinking, well, how are you paying your investor back if you haven't got all the money back out? Well, because I am in a bit more of a lucrative cash position now than I was, say, when I first started, that's how I can combine the hybrid of the bridge and the investor money, because I know that if I don't get all the money back, then I can pay the investor. So I will have topped the investor back up with that 21k, and now I've got that money in the deal. And as you can see here, this is netting me a 20% return every single year. So a fantastic deal. So I think now is a good time to discuss ROI and ROCE, also known as return on investment and return on capital employed. And the reason why these are important figures for property investors, it goes without saying, the higher the ROI, the better the investment is. And in property terms, this tends to mean cash flow. ROI is calculated as the increase or decrease on the initial investment, and you have 2 figures, gross yield and net yield. There are many calculators like the one I am about to show you, but I think as a property investor, you should really get to grips with the maths, as these numbers help you decide whether to invest your money or not. For example, you might buy a villa here in Dubai for 10 million, that looks amazing, and you rent it out for 800k, which sounds a lot, but that is only an 8% gross yield. After you take into account financing costs and possible bills, including things like maintenance every year, your net yield could be lower than 4%. Now let's compare that example to my deals and discuss the different types of ROI and how to work them out. So your return on capital employed is, as it says on the tin, what is the return based on how much money you have invested? So as we can see here, if we talk about the spreadsheet, so we're looking at D70, so is the refinance monthly cash flow times 12. So on an annual basis, how much money is that giving me on a net basis, divided by D69, which was the amount of money that I put in to get the deal. So you can see here, this is a 40% return on the capital employed because the cash flow is good and I haven't actually put that much money into the deal. Now you say this one is a better cash flow deal, and it's a higher ROI, but the ROCE is less because obviously it's cost me more to get into that deal. So that's return on capital employed. But I think the main figures that investors work on is ROI. And you've got two types. You've got your gross and your net yield. So your ROI, again, is based on E38, which in this here is what the monthly rent is, times by 12, so again how much we're earning on a yearly basis, and then divided by E23, which is the purchase price of the property, and that gives us our gross return on investment. Now, the return on investment that I like to focus on is obviously the net, because as I explained before with our Dubai example, it could show 8% ROI, but after all considered, it could drop down to 4. Now, as a wealthy person, you could probably go knock on some major banks and get more than 4%. So it's not really that good of an investment. Now, the net is what is coming into your bank account. And if you can get anything north of what we work out as kind of the inflation rate, so more than probably 8 to 10%, then your money's going to be continuing to build and you're going to be keeping ahead of inflation, and that becomes a very good investment. Most property investors are looking around the 10 to 12% mark in the main, depending on the markets. If you're investing for cash flow, if you're investing for capital appreciation, you might look at it a different way. But for me, I invest for cash flow. And, you know, as you can see here, running them as serviced accommodation units, you're always in the double digits in the main, apart from on this one smaller property. And the smaller properties do tend to have a much lower ROI. There's many calculators that you can use. I know this one's in dollars, but the idea is fairly similar. So, you know, let's say we invested 100,000 and it's returned 20,000 and we've put it in 1 year, then naturally that's going to give us a 20% ROI. Oh, on this calculator, you need to do a different way. So it's giving us 120,000 return because obviously we've made 20 grand profit on the 100 grand that we've invested. And as you can see, we've got a 20% ROI. So if you are struggling to work out ROI, there's loads of calculators. But as I said, the typical maths is the amount of money that you're making per year, and then you divide it by your initial purchase price for the ROI. And then if you want to do net, you work on your net figure that you're earning per year. And again, you divide it by the initial purchase price. Hopefully by now you're starting to improve your property investing knowledge and see how you put deals together and maximize your cash flow by running them on Airbnb, booking.com, etc. One thing I haven't touched on yet is my direct booking game, which really makes a difference to the numbers. As you can see, my direct booking game stands at 74.27% at the end of October, which is when I am recording this video. This hasn't just happened by pure luck. There are many factors involved in generating this result, and the main benefit is the profitability increase, as I am not paying 15% or so to booking channels for my bookings. Stays tend to be longer than the bookings that Airbnb and co bring in, and the turnover costs reduce, plus I have full control over the guest and my money. Airbnb can dip their greedy little fingers in my bank account and pull out money for their ridiculous air cover claims. If you would like a deep dive video on the steps I've taken over the years to produce this result, comment direct in the comments box. And again, if enough people do, I'll put a video together specifically for direct bookings. For the final two properties, I'm not going to go through them in detail. I will play some nice background music and put the figures on the screen so you can see the numbers before we dive into the real juicy part of this video. So making money is one thing from properties, but keeping it is another. As you run your serviced accommodation properties as a trading business and not an investment business, like most landlords do with tenants, it opens up a huge tax benefit for UK Airbnb investors. So if we ask our good friend ChatGPT what are capital allowances, it's going to tell us allowances are a tax relief available to businesses in some countries, including the United Kingdom, to offset the cost of certain capital assets such as machinery, equipment, and property against their taxable profits. These allowances are designed to encourage businesses to invest in capital assets by providing a way to deduct part of the cost of these assets from their taxable income over time. In our world, this means the bits and bobs that don't fall out of a house if you were to turn it upside down and shake it. You need a capital allowance assessor to value the property and a tax specialist to dissect the information. Your accountant might be able to do it. If they don't know how, they should be able to recommend someone. Failing that, send me a DM on Instagram and I'll put you in touch with mine. Every property will produce a different figure, but I have found the range to be typically between 21 and 28% of the purchase price. So if we look at the 5 deals we've been discussing, the values would be 15,330, 29,794, 26,220, 35,175 and 19,425, a total of 125,943. In essence, what this means is each property can earn that amount of revenue without being taxed on it. So effectively £125,000 tax break. Amazing, right? I know. You can thank me later. So, I'm sure you've heard the saying, bigger is better many times before. I'll let you decide what the context of that is, but for me, talking about property and especially investing in properties for short-term rentals, bigger is always better. Coming back to the 5 deals, if you look at the net profits of my deals, the 1-bed flat doesn't produce anywhere near as much as the profit of the larger houses. And another thing to mention is the direct booking percentage on that flat versus the houses is vastly in favour of the bigger stock. And this pattern runs through my entire portfolio. So you really want to be trying to invest in larger properties in the right areas. If you found this video useful, please give it a like and share it with someone. See you on the next video, and don't forget to watch this video.